What's going on, everybody? Welcome back to another episode of the OIG podcast. We have Kevin Orsinger, myself, Max Messett. And just like we kicked this podcast series off with the Q1 market update, we're going to go ahead and roll into the end of Q2 market update here. And Kevin and I have done a lot of talking about this, and the first thing that comes to mind is we cannot believe that it's already the end of Q2 and halfway through the year. I think you can agree on that, Kevin. We've had quite a realization over the last couple of days.
Yes, it has. It's gone by quickly. The markets have done a little bit of everything from the start of January 1 through the end of June. So it has been eventful,
Yeah.
To say the least. But for those that stayed the course, probably a positive year to date.
Yeah.
For smart investors.
Yeah. A lot of good things on each side as well. I mean, in the sector side, in the broad market, a lot has happened. And that's kind of what our goal is with this, touch on those and give you guys some good information looking back from April 1st to June 30th, Q2 of 2026.
So yeah, we had a very good rebound in quarter two. Just a reminder, the cause of the downfall in quarter one was the beginning of the Iran conflict.
Mm-hmm. Yeah.
Back end of February. So March gobbled up all of the gains we had year to date at that stage. The news cycle pretty much on any story seems to be about 40 to 45 days, and then the markets get a little bit tired of things. So I'm not sure much has changed or improved in Iran, but the markets are tired of talking about it and hearing about it, and they just went back to business as usual. So just a quick numbers recap. The NASDAQ in quarter two was up almost 21.5%. Dow was down, was up nearly 13%. S&P was up almost 15%. The EFA was up 9%, and the Bloomberg U.S. aggregate was up about 1%. So stocks and bonds all did well. Year to date, most of the major indexes are high single digit, low single digit returns year to date, and something that we hope continues. Corporate earnings have been really strong for quarter two. So about 85% or so of companies that reported beat the estimates, and that is well above historical averages. It's much lower than that generally. So the underlying companies have done well. Another big part of the markets and what's led to NASDAQ's growth is the AI trade has come back.
The AI, baby, it never left. The AI never left. It sticks around and keeps sticking around.
It will be a bigger and bigger part of the markets moving forward. I think there is some realization that this is definitely going to be part of our future. It's not here yet at the levels it will be, but it's getting significantly closer. And the markets are all about what's the future upside of something look like. And although there's not a ton of companies that trade public that dabble in the AI only space. The chat GPTs and Claudes of the world are privately held companies, but Google and Apple have their own AI tools that they're using. So there is part of it. And then obviously the underlying software that's used comes from the NVIDIAs and Intels of the world. And those companies have done well too. So
I was going to say, I think everybody at this point that is probably, if you're getting on this, you've probably used some sort of AI in your time, whether that be just Google on your phone. There's AI about integrated in everything. So I don't think the private part is I think that the public section of this is what we all get to see day in and day out. And that all transforms over to the sector side of this as well of, surprising on this side as we talk about the Iran stuff going on. Energy actually did take a little dip in Q2 here, just on year to date, still going strong in a leading sector in the market. But it did come down about 10 to 12%, was up over 35% ending Q1, sitting around that 22, 23% still up year to date, ending Q2. Reason for that is kind of like Kevin talked about. Iran stuff is still going on. As you guys have noticed, the gas prices at the pumps have slowly, and we're quick to say slowly, started coming down. That is because the price per barrel of oil has come down and is sitting around that $71 to $73 mark here recently. couple other things that are doing well. Industrials was up big, 13% in Q2, and then information technology. Information technology sitting hand in hand with that AI kind of boom, cloud, all that deal that has been going around and staying strong with that. There was some lack in Q1, if we remember, in the AI space with kind of money not being spent on it. And like Kevin, you hit on that 45-day window of there was a big expectation that kind of didn't have a whole lot to go with it. Is that fair to say?
Yep, that's a good way
Yeah.
to say that.
Yeah. So information technology, there has been some money put into it in Q2 here, so it has done well. Industrials, for this AI stuff, buildings have to be built, data centers have to be built, and there is a lot of, I don't know if a lot of viewers of this have put eyes on stuff like that, but they are not small infrastructures. They are not just a little one room thing. They have some serious materials that go into them, and machinery that's needed for them, and steel, all that good stuff, and the infrastructure really is the base of that industrial, being able to get companies put together that are going to be able to put these data centers up and continue that AI push as we continue into Q3 here.
Yeah, the CapEx spend
Yeah,
that's coming, and I'll say the next 5 years to 10 years for everything AI related, from the hardware, as you said, to the structures is going to be like unheard of.
Yeah.
With what we've seen before. Everyone wants to try to compare this to the early 2000s tech bubble that we had. And I don't want to say they're night and day, but I don't believe that this is anywhere near what the tech bubble was. Most of those companies that were trading high on the stock market had limited earnings. There are some big players, like I said, Google and Apple are involved, Anthropic and Claude are turning into, even though they're privately traded, are turning into big time players with big deep pockets. So the continuation of this, I think, is going to continue. Are there some unintended consequences of the AI trade? Absolutely.
Yeah.
There's going to be some job loss along the lines with it. There's going to be some straining and stressing of some resources in communities that have these data centers. But if you can wipe away all of that and just put your investor hat on, participating in the AI trade is probably going to pay some pretty good dividends for the coming years.
Yeah. And with that being said, too, and kind of like you hit on, Kevin, is a lot of this AI for some of these companies that you're talking, Google and Apple, they've been built on solid rocks before this AI time has come about, right? I mean, they have that opportunity now. Who can be a big player in this? And we've seen some pretty cool features rolled out here, just I'd say in the last 6 months to a year, of a lot of automation. And I just say that on the side of Google, and I know just about Microsoft has their own now with their pilot, I believe. And there's a lot of, it doesn't matter what you go on, there is some sort of AI intelligence that is going to lead you to try and get you your answer. Before it was, you go to the search bar of Google and you hope you'll type the next 10 times what you need to find, but it has had the benefits with it. But that is also, a lot of these companies, they're not relying on AI, I guess. They have a solid foundation that this is their opportunity to maybe jump ahead.
Yeah. Microsoft with Copilot and Google's, I don't remember Google's name of it. This is just an extension of what they already do.
Yep.
This is a way of diversifying we'll call it their product portfolio.
Yeah.
Missing out on this, if they made a conscious decision not to participate in this, has a significant negative impact for them over the next couple of decades. And the leadership of both those companies are smart enough to know that they want to participate in this. It's just funny in day-to-day conversations how many, I'll just say, average people like you and I, Max, use it.
Yeah, right.
Right. It's not just corporations. It's not just large companies. It's everyday people are using it more and more and seeing the value in it. And that will only continue to grow as time moves forward. So not by any means near the finish line with this. I would say we're probably, a third of the way through the race, maybe a quarter of the way through the race. Because even I'm a Chat GPT guy, that's kind of what I learned. And ultimately, I don't like change, so I've stuck with it. just the adaptations that have been part of that in the last 6 to 9 months has been pretty amazing. That gets me excited for what's the next year to 2 year
Yeah.
look
Yeah.
with what it's able to present to you and provide for you. So again, one of the unintended consequences too is I don't do any free thinking on my own anymore.
Right. Right.
Did I have a thought and I plug something into ChatGPT and it gives me
Right.
the answer, it gives me an approach or a way to do stuff. So it concerns me a little bit that maybe we're not going to be the thinkers that we used to be.
Yeah.
Because ultimately we're just going to rely on the AI to come up with stuff for us. And hopefully that's not the case.
And with that, I think kind of like Q1, we talked, I think it was Q3 and Q4 last year as well, is that monetization of some of this as well. Is how can these companies, turn some of this into money for them, which then allows them to make some advancements in there, taking some of that profit and using it for putting it back into the company and get some of this AI going forward. I know that was something we looked at later last year as well, of how does that stagnation, right? At some point, somebody has to make that next advancement
Sure.
to go into it. So it's a matter of the money and who gets there first, I think, is what that looks like.
Yeah, it's the new model everybody's on now that
Yep.
provides service, whether it's a Microsoft or even a Netflix or something.
Yep.
It's the subscription based, right?
Yeah. Yep.
You're paying X number of dollars a month. It doesn't seem like it's that much money, but you're paying it whether you use it every single day or twice a month, and you kind of forget that you're paying for it. But at the end of the day, yeah, again, whether it's ChatGPT or whoever, it's a revenue stream for them, which they need. If you're a Google or Microsoft, it's a new revenue stream
Yep.
that you didn't have. And as you said, at some point in time, this only works for these companies if they're able to monetize the service they're providing, because they have invested a ton of money into it. The Googles and Microsofts of the world have a little bit of a head start because they have a built-in user base already.
Right.
Right.
Yeah.
But with that being said, a lot of people use Claude, a lot of people use ChatGPT because I think their product is ahead of some of those leaders. So can Google catch up? Can Microsoft catch up in the coming years? It will be interesting when Anthropic, which is the face of, or ChatGPT, I guess, is the face of Anthropic, when they decide to go public. I'm curious to see what the financials look like.
Yeah.
Because the burn rate on the money that they're bringing in has got to be alarmingly high.
Yeah.
At this stage. So.
It will definitely be interesting to see where that AI kind of heads down and the roads that they start to take. Something I do want to jump back to, and not to jump off, is just go back to that energy sector. I know we kind of hit on that, the Iran stuff going on and oil coming down. Looking at the consumer kind of base, I know you had a really good terminology. I'll let you kind of use it with the rocket there.
Yeah. So at the end of Q1, oil was $67 a barrel. And at one point in time in early April, it hit $115 a barrel. Yeah. And as you said, it's down around 71, 72 at this stage. And within the industry, with oil prices have come down, but as you've seen at the pump, your gas prices haven't come down that much. And they refer to this as the feather versus rocket effect. So as the price of a barrel of oil went up in March and early April, you felt it at the pump immediately.
Yeah.
Immediately. And that's the rocket side of it. The price then comes down on the back end, the situation we're in now, as a feather. So it just kind of floats its way down. It doesn't have that direct drop. But lower gas prices are coming. It's unfortunate that we want lower gas prices, and it's during a summer period where historically gas prices are up. June, July, and August are generally the higher 3 months during a calendar year, because gas companies know that people travel. They're going to have to pay what we're charging them because they want to go on vacation. They've got to take kids to ball games, whatever. But yeah, it coming down, but not coming down at the rate they went up. But that is the norm. You can call it capitalism, you can call it greed, whatever side of the fence you sit on. We're about 30 to 40% or cents lower in our area, Western Pennsylvania. The national averages, it's down about 60 cents from the high of the last 4 or 5 weeks. So it's heading in the right direction. It just takes a little bit longer to get there. Than I think what consumers would like. And I kind of have that same sentiment. You raised it on the news that the price of oil was going up But you're charging it on the oil that you have or the gas you have in your tanks that you paid for 2 weeks ago.
Yeah. Yeah.
So it seems wholly unfair, but that's the way it's been, and that's the way it will continue to be. I think, provided nothing comes up with the Iran conflict that closes the Hormuz Strait, I think we can expect to see a continuing slow decrease in those gas prices, and hopefully we get into September and they get a little bit more normalized once summer ends.
I think, that's kind of like you said, is with that, Iran conflict too, kind of the long game still. New news is not good or bad news, but old news that's getting sat on for that long, the markets eventually get sick and tired of it. We have seen in Q2 itself some days of there has been news that gets thrown and the markets do react, not long term. They have not reacted as far as, this is a 2-week, 3-week, 4-week, because of this conversation. Instead, I think as we continue to get news on that conflict and things continue to get resolved, hopefully the path of oil continues to stay the same and gas prices do the exact same thing. And the feather hopefully falls a little bit quicker, because I think we would all appreciate a little lower gas prices at the pump here coming up pretty quick.
And gas prices affect everything. So that's going to affect the cost of goods and services. Going to the grocery store, the guy that might mow your lawn, that, he's got to charge you a little bit more, some sort of surcharge because of the fuel prices. So, hopefully they come down. The volatility I think that we had in the second quarter, Max, was more driven by profit taking than maybe news cycles.
Yeah.
What did we say? The NASDAQ finished up almost 21.5%. Year to date, and throughout that, you want to take some money off the table periodically,
right.
And sometimes when that happens, everyone jumps on the same boat, and you have a trading session where you're down 4%. And then the next day you get some of it back, and the day after that you get the rest of it back, and the third day you're back above where you started. So as you said, as long as there's current news or good news coming out of Iran, I think things are okay. And at this stage, no news is good news for the markets. Ideally, we'd like an end to this so we can just take it off the table and don't have to worry about talking about it. Because what got added to the table here at the back end of the quarter was new Fed Chair Kevin Warsh surprised the markets as they started talking about potential rate increases by the end of the year and not decreases, which I think the markets were hoping, if not expecting. So we had a couple down days off of that. There's at least one Fed governor that would like 3 increases by the end of the year. I don't expect that to come true. But I'm now in the camp of, I would think between now and December that we get at least 1 raise. Whether that's a 1/4 point or a 1/2 point will be seen. But they've taken a little bit different approach. He's going to be a little bit more aggressive than Chairman Powell was. They're set to meet here in about 3 weeks. They're the back end of July. I'm sorry, I guess we're about 4 weeks at this stage. So hopefully we get some droppings of information between now and then to give us an idea of what might be happening. The other interesting thing, Max, was no more forward guidance from the Fed chair. Jerome Powell always kind of gave you a look at maybe what they were expecting or thinking was going to happen. And Chairman Warsh, that's a tough name for me to say for some reason. Chairman Warsh came out and said, we're not doing that. Everything that we do is going to be data driven. And there's no sense giving you any potential scenarios or prognoses of what might happen. Here's ultimately what the data says, and here's what we're going to do. So they're going to take some of the speculation out of it, which I think is a good thing for stability. Side note, everyone kind of likes to think they know what's going on, and them helping you with that makes you feel smarter. But I think the reality of it is, for the market's case, I think just give us the facts. At this point in time.
And it's the same thing on the sector side. I hit on the financials last quarter, so I decided to do it again this quarter. Still lagging. Financials still kind of in that back running pack there. We're positive for Q2, but not a whole lot as far, there wasn't a lot of made up ground. And due to that volatility, I kind of look at it as, we look at as consumers, the volatility on interest rates really determines some of the decisions that we make as well. And I like to put that just kind of into that context of somebody that might be thinking about refinancing their house. How much of interest rates move? Something that goes from 6.5 to 6.45 probably doesn't move enough for you to really. So you're thinking, well, is it going to drop? There's a lot of talk about it dropping. Is it going to go up? Should I stay where I'm at? Should I do this? That's the volatility that we talk about when we kind of hit on this of, you don't know what those next steps look like. When you hear some news that, hey, there might be an increase, it's like, well, I'm not going to refinance, or maybe I do refinance on a lower rate. There's a lot of speculation. There's a lot of volatility. And as consumers, that is what makes decisions a little harder because you don't know it. You don't want to refinance and I'm just using refinance because I think it's an easy term that everybody kind of, gets there, or buying a car. Let's say, you don't want to buy a car if it's say 5%, but in 2 months it could be 2.5%, right? You never want to go on that whim of, so we wait and see. That delays the purchase, that delays the financing, and that's kind of across the board with some of these interest rates and mortgages, and really it plays into everything when we look at interest rates. As far as bank side, consumer side, it goes across the whole board. So the volatility, it really throws a loop, which doesn't allow that sector to really put its feet in any solid ground. It's kind of standing in sand and shaking around. So until I think we can get some more direction on that will kind of continue that way. But that's kind of, volatility is never good for that.
No.
I think we've seen that across anything. So
yeah, treasury yields are up to 10 years up year to date.
Yep.
Almost to 4.5%. It was at 4.18 at the beginning of the year. So those of you that are investing in treasury bonds or own investments that own treasury bonds, that's a positive thing for you. For those that are looking for new mortgages and car loans, you ideally would like that rate to drop some. And as Max said, we're a little fearful that we're not going to see any significant drops on those yields anytime soon, especially with talk of potential increases. It could go the other direction. I was listening to another podcast, ironically, today, and they were talking about, when is the right time to refinance a home, or when is the right time to upgrade from your starter home to your next one. And the one guy's conclusion was perfect. And he said, at the end of the day, the math is going to be what it's going to be.
Yeah.
Can you afford the monthly payment? And are you going to improve the quality of your life by making that decision?
That's it.
And if those two answers are yes, it's probably the right time to do it. Is it the perfect time? Like you said, ideally everyone gets 2.5% on a 30-year mortgage, but we're a ways off of that scenario.
Yeah.
So do you sit in a house that maybe you've outgrown, or do you just say, we're going to have to buy something bigger. We're going to have to pay a little bit more. We can always refinance in the future, but the important thing is today we can afford the payment.
I don't think, Kevin, I think I'd argue too, there never is a perfect time. I don't think the stars always align and all of them line up. And I don't think the perfect time really exists, but I think those questions, you got to ask yourself a couple and kind of do some self-awareness of, does this make sense where we're at now? Monthly payment, money that's going to be going towards it. What's our situation? And those are the stars that have to line up. The perfect stars, I'm skeptical that those never actually always line up. Right. So, but that's good. So
anything else to add, Max?
No, I think that's kind of, like I said, that's our Q2, end of Q2. I keep saying Q2 like it's the beginning. It is the end. Guys, we are in June here, so we are quickly rolling through the year. Q3 will start tomorrow from the time we're recording this. So
and we should, we'll probably see some continued short-term volatility through the rest of the summer. The summer, June, July, and August are usually a little more lightly traded than the other 9 months of the year. And then we get into September and October, and we're getting close to those midterm elections, which will provide, I think, some volatility of the markets as well. Again, I'm not anticipating, based on the information that we know now, that anything is long lasting. We just may have a couple of day periods, 3-day periods where, the markets are digging into our pockets a little bit. But I think ultimately the year ends in a better position than it is today. And we'll just have to see. We'll have to be patient together.
That's it. Well, guys, we always appreciate you taking the time to watch. Here is that slide if you want to get connected with us or check out our socials. We have all the other podcast episodes, YouTube, Facebook, I guess on YouTube, but we share them all. I get the links to Facebook and everything. So check us out with that QR code. You have both of our numbers, emails there if you want to get a hold of us separately. But Like I said, we always appreciate you guys tuning in. I hope you guys took some good things for this in Q2, and we will keep an eye on Q3 as we head into it here. We'll bring it to you next, or not
Excellent.
next, but that will be our next quarterly market update at the end of Q3.
Perfect. Thanks, Max.
Yep.